Hi, I'm Courtney Hoffman. I'm the Director of Planning here at Everpar, and I am welcoming today Shawn Alexander, CPA and owner of Alexander Accounting Services. Also, Shawn is a fellow OSU Cowboy, so go Pokes. But Shawn is someone that we work really closely with when we are working on tax strategies with clients, and so I thought she would be a great guest today to join us, and we're going to talk about a couple of unique topics today. So thanks for joining us, Shawn.
Thanks for having me. I'm super excited to talk about all the fun things about tax credits with you today.
Tax isn't always the most fun topic for people, but we're going to try to make it fun today. So Before we get into the specifics of the strategy that we're going to be discussing today, one of the things that I thought you might be able to cover first is just giving us a quick baseline on the difference between a tax deduction and a tax credit.
Yeah, great question. So a tax deduction lowers the amount of income that gets taxed. So this results in usually anywhere from 20 to 37 cents of tax avoided on $1 of a deduction. People typically recognize the deduction in the sense of the standard deduction versus the itemized deduction, where you think of your charitable giving, deducting your property tax, those type of deductions. Whereas a credit is a dollar for dollar reduction of your tax owed. So two things worth noting with credits is there's the non-refundable, which can reduce your bill to zero but won't generate a refund, and a refundable credit, which results in a refund even if you don't owe any tax. So for a quick illustration, $1,000 of a deduction can save you up to $370, where $1,000 of a tax credit can save you $1,000 of tax owed. So in simple terms, the deduction lowers your income, where a credit lowers the actual tax owed.
Thanks, Shawn. Most people do know about deductions, but there's a category of tax credits that most people have never come across. Can you explain what transferable tax credits are?
Yeah, a transferable tax credit is a credit that was earned by one person or a business but can be sold to another taxpayer. So typically, the original credit holder is typically a developer or investor who has earned this credit through a variety of different activities, and they would rather get the benefit of that tax credit now and free up their cash flows, so they end up selling that instead of recognizing it over the course of a few years. The buyer will typically pay less than face value. Right now we're seeing about 94 to 96 cents on the dollar because there is some timing and compliance risk with specific credits. One thing to consider is there's no specific generalized framework for these transferable tax credits. Each credit has its own rules and regulations surrounding it, so it's important to make sure that you're taking all of those things into consideration.
So if I'm a business owner and I have operations in multiple states, could I actually buy credits in different states?
Absolutely. If you have an income tax liability in multiple states, it's very likely that there are transferable tax credits that could apply to most, if not all, of those states.
Thanks for that. So could you walk us through a real Oklahoma example so that people can see how this actually works?
Absolutely. So a great example is the Historic Rehabilitation Credit that the state of Oklahoma offers developers. It's been around for decades, and the statutes expressly allow transfers. The credit is based on qualified rehabilitation expenditures for certified historic structures. The Oklahoma credit is 100% of the federal rehabilitation credit, so they apply equally. A great example is if a developer rehabilitates a historic property in downtown Tulsa, the federal and Oklahoma credits, let's say they come out to $1 million. The developer may want that $1 million credit in cash flow so they can start on another project, and so they'll sell that for a discount so they can move on to their next investment. One thing to note, since you are buying these transferable tax credits at a discount, there is a risk of recapture. Typically, the credits won't be sold until the time period for recapture has passed, which means that there's no risk involved for the purchaser of the tax credit. But that's something that you need to have a conversation about with your CPA to make sure that they're compliant with what the statute is saying.
Shawn, you mentioned that historic rehabilitation credit, but what are the other types of transferable credits available in Oklahoma beyond that?
Right. So we are lucky to live in a state that is booming with energy. And so there are quite a few of energy credits available. The coal credit is a big one, and there's a variety of others that have appeared in state law over the years. The landscape does shift over time as legislation adds, modifies, or sunsets different programs. So this is why it's also important to make sure you're working with your CPA and your financial planner who are keeping track of these different legislative changes.
Yeah, and I would just piggyback off of that and say that, at Everpar, I know we do have a lot of clients that are in the oil and gas industry. So this does come up somewhat frequently amongst our client base. And, one of the things we've done is worked really well hand in hand with you, that if we identify somebody that, may be interested in something like this or could take advantage in something like this, we typically will reach out to you from the CPA perspective and then, coordinate between both of us to see if this makes sense. It's really vital to get ahead of this on the front side versus on the back side on the planning perspective.
Absolutely.
Okay, Shawn, next question. If somebody wants to pursue a transferable credit as a buyer, how does that process actually work?
Yeah, so the first step is, of course, to speak to your CPA and your financial planner to make sure it actually works in your tax situation. Then you would need to find a seller, which is typically a bank who has purchased these tax credits from a developer, investor, or a project owner. You want to confirm that the credit is actually transferable under Oklahoma law. Many credits are not, and so it's important to make sure that we understand what we're purchasing. Then let's review the transfer mechanics. States often require a written transfer agreement, notice to the tax agency, and sometimes surrender of the original certificate with a replacement certificate issued to the buyer. Once you obtain the replacement certificate or the state acknowledgement that you now own the credit, you can claim that credit on your Oklahoma tax return, just making sure that you have the required documentation attached. This isn't something that you can do overnight, so it's really important to start those conversations early so that way you're not running against the clock come tax season.
You lost me on half of that, so I'm glad that we have you to lean back on to help us with the mechanics.
Courtney, how does this fit into a broader financial plan? When it comes up with an in-client conversation, how do you think about it?
Sure. So I think the important thing is that this just doesn't live in isolation, right? We can't just take the tax benefit into account. A couple other things that you really have to think about is cash flow and liquidity, because you have to purchase the credit. So depending on the timing of that, that may or may not work. Also, there are risk implications. So this has to fit into your overall plan. And then it's not just whether you can buy the credit, but whether this actually makes sense for you. Oklahoma tax liability really needs to be of a significant amount. If you have W-2 wages, from general employment income, it's usually not a good fit. Typically what we see is that, business owners or really high income earners are where this is going to apply more so. Again, we typically will identify someone that we think this may work well with, or someone may approach us. We'll really take a step back, look at the holistic approach. And then once we say, okay, yeah, this is worth pursuing or looking further into, that's typically when we're going to loop you in and really work together with their CPA to take it from just the idea or financial planning thought to actually how would it work into their tax picture, modeling it out before we proceed to the next steps.
Yeah, I think that was a great illustration about how collaboration between a CPA and a financial planner works, so thank you. For someone watching this, how do they know if any of this actually applies to them in their tax situation?
Yeah, I think it's just really important to be transparent here and say this isn't going to be something for everyone. This is typically going to be kind of for a very specific group of individuals or people. Back to what I said before, just in that you've got to have meaningful state income tax. So this isn't just a federal income tax liability. This is really specific to Oklahoma tax liability or, whatever state we're talking about. If it's not Oklahoma, understanding the deductions, credits, how this reduces AGI, that applies to everybody. And then really this transferable tax credit is an additional layer above and beyond that. So again, it's a very specific planning focus. Most people may not know about it, or some people may have heard about it, but they don't really understand what it entails. So that's where you and I are going to work really, again, hand in hand to make sure the client understands whether it is applicable and then how to apply it. If you're not sure if any of this applies to your situation and you want to talk this through further, please don't hesitate to reach out to us or your financial advisor or your CPA to get that conversation going. And I just want to say thank you again to you, Shawn, for joining us today and walking us through that. You gave us a lot of really meaningful information to ponder on.
Thanks so much for having me. It was a great conversation, and hopefully everyone learned something today.